Are you thinking about selling property in Hawaii but live out of state? Or you're not a resident? There's a little known tax law that could take a big bite out of your profits. And you might not even know it until it's too late. It's called HARPTA. If you're selling property in Hawaii, this law could withhold over 7% of your total sales price up front. That means they're taking it away at the escrow table. Yes, you heard me right. 7% of the total sales price, not just your profit. That's a heavy hit, right? But don't worry, this video I'm going to show you exactly what HARPTA is, HARPTA, why it exists, and most importantly, how you can reduce or avoid this hit to your wallet. Stick around because this could be the key to saving you thousands on your property sale. Why should you care about HARPTA? Let me paint a picture. You sold your vacation home, let's say in Maui, or maybe an investment condo in Honolulu. Everything seems smooth until you get to closing day. And suddenly you're told that 7.25% of the total sale price is being withheld by the state. This could be tens of thousands of dollars completely unplanned. And if you think about it, Hawaii property sales normally $1 million or more. So that's a hefty bill that you have to come up with. So HARPTA stands for Hawaii Real Property Tax Act. And it's specifically aimed at non-residents who sell property in Hawaii. Essentially, the state wants to make sure, that non-residents pay their fair share of taxes on capital gains. And they do this by withholding a portion of the sale until you file your Hawaii state taxes. If you're a non-resident and you sell property in Hawaii, HARPTA applies to you, plain and simple. But there's the good news. You don't have to lose that entire 7.25%. In this video, I'll show you how to navigate the process to minimize the withholding and even get a refund out of it, hopefully. Let me tell you a quick story from my own experience as a real estate investor. I was selling a rental property in Oahu a few years back. I thought I had everything under control. I had my closing documents, my buyer was ready to go, and then out of nowhere, I was hit with HARPTA. I had no idea about this 7.25%, the total sales price be held at closing. The sale price was around $600,000, and just like that, nearly $44,000 was withheld. Imagine thinking you're about to receive a nice lump sum from your sale and only you're told that tens of thousands are going straight to the state instead. Yeah, that's a hefty load. But here's the thing, once dug into HARPTA, I realized I had options. And I was able to reduce the withholding and eventually get some of that money back. That's what I'm here to help you with. Don't make the same mistake that I did. Let's break it down, the HARPTA, and how you can navigate it in 3 key steps. So step 1, you're gonna understand the withholding. I said again, you're gonna understand the withholding. HARPTA requires that 7.5% of the total sales price withheld at closing for non-residents. Notice I said that total sale price. This is one of the most important things to understand. It doesn't matter whether you make profit or not. The withholding is based on the entire sale price of the property. Let's say you sell the property for $600,000, but after paying off your mortgage, your real estate commission, and closing costs, you only walk away with $100K. Where HARPTA 7.25 of that $600,000 is withheld, which means you will see $43,500 deducted from your sale. Money you might have been relying on for your next investment or your personal plans buying another home. This is why it's important to know about HARPTA up front and plan accordingly. Step 2, filing for a reduced withholding. This is very important. This is the meat and butter here. Here's the good news. You don't always have to be part with that 7.25%. There's a way to apply for a reduced withholding if you believe your actual Hawaii state tax liability will be lower than the HARPTA amount. This involves filing Form N-288B with this Hawaii Department of Taxation. Let me explain how this works. So Form N-288B is essentially your chance to show that the state that you actually tax liabilities based on your gains and deductions will be lower than what HARPTA would have withheld from you. This form needs to be submitted well in advance of your closing. So timing is the key here. Once approved, the state can reduce the withholding or even waive it entirely if you can prove you don't owe as much in taxes as HARPTA withholding suggests. So how do you prove that? Your tax liability is lower than the HARPTA holding? Here's a few quick examples that you can kind of look at. Example one, selling at a loss. Let's say you bought the property for $500,000 and you're selling it now for $450,000. Since you're selling at a loss, your actual tax liability could be zero or very low. By submitting the appropriate documents that prove the loss, you can ask the state, hey, to reduce, eliminate the withholding. Now, the other example is pretty much if you got like a high selling expenses. So maybe you sold your property for a profit, the selling and the taxable gains, for instance, if you sold for a property for $600, but you spent $50,000 on renovations, $35,000 on realtor commissions, and another $15,000 on closing costs. That $100,000 in expenses that reduce your taxable income. So that's accounted for. By providing the documentation of those costs, you can lower your reported gains and therefore your tax liability. Example 3, tax credits or deductions. Another common situation is if you're eligible for state tax credits or deductions that lower your overall liability. Maybe you've invested in solar panels or other energy efficiency. That's my favorite thing is solar panels. I put one on everything that we try to buy. Energy efficient upgrades that will qualify for tax credits. Or perhaps you qualify for deductions related to property management or mortgage interest. By showing evidence of these deductions, you could further reduce the amount of taxes owed. Now, this is crucial. Don't wait until the last minute to do this. If you're selling property in Hawaii and you know HARPTA applies, start preparing the file form months before your closing date. It could save you thousands at closing, but what if you don't file the form in time? That's where the refund process comes into play. These examples illustrated pretty much, the practical ways of non-residents can prove their taxable liability is lower than the HARPTA withholding by demonstrating either losses, the expenses, or deductions. These additional contexts should help you better understand and reduce or avoid that full 7.25% withholding. So step 3, get your refund. If you don't know, once you completed all the sale, you'll file your Hawaii state tax return for the year. When you file, you will report your actual gains and tax liability. If your tax liability is less than the amount withheld by HARPTA, you can apply for a refund of the difference. For example, if you had $43,500 withheld, but your actual state taxes only amounted up to $15,000, you can get the remaining $28,500 refunded to you. But this is important. The refund process can take several months, sometimes up to a year. So if you're counting on that money, just be aware that it might not come back as quickly as you'd like. One thing to note that HARPTA isn't unique. In fact, it's modeled after the federal FERPTA law that formed based off of Investments in Real Property Tax Act, which also withholds funds when foreign nationals sell U.S. property. So HARPTA is essentially Hawaii's version of, but it applies specifically to non-residents of the state. If you're a Hawaii resident, you don't need to worry about this withholding. But if you're like me, an out-of-state investor, definitely need to prepare for that. That was my prior timeline. Now I became an actual Hawaii resident, so now I don't have to worry about it. In the past I did. So to recap, HARPTA is a 7.25 withholding on the total sales price of the property sold by non-residents in Hawaii. But if you plan ahead, you can reduce that amount even getting a refund by filing the right paperwork. Selling property in Hawaii as a non-resident doesn't have to be a financial surprise. The key is understanding HARPTA and taking the right steps before closing. If you found this video helpful, be sure to hit that like button and subscribe for more tips on real estate investing, tax laws, and how to make the most of your property sales. And don't forget, if you're looking for more information on timing your property sale for the best return, check out my next video right here.